So moving on to the first set of ratios, solvency ratio is divided into two parts, liquidity ratio and the turnover ratios. So what is liquidity ratio? Liquidity ratios basically measure how liquid the company's assets are. So what does it mean? It means that how easily can the assets be converted into cash. That is compared with current liability, and hence we get the liquidity ratios. So the first ratio under liquidity ratio is the current ratio. Current ratio is used to measure and understand the relationship between the current assets and current liabilities. So it is a fairly simple one. The formula for current ratio is current assets divided by current liability. The current ratio answers the question, how many dollars of current assets do we have for each dollar of current liabilities? Current ratio in itself does not provide us with full details on the quality of the current assets and whether they are fully realizable or not. For example, if the current assets consists primarily of receivables, we should investigate the quality of those receivables and whether those are going to be converted into bad debts. That is going to decide whether or not it is a good idea to include receivables, for example, in the current ratio formula. The interpretation for current ratio is that when the current ratio is 2x, that means the current assets are 2 times the total number of current liabilities. Hence, in this example, the current assets are $200 while the current liabilities is at $100. Hence, the current ratio is 2x.